Welcome back to Bloomberg Markets. Elon Musk has ditched Twitter's Blue Bird. Over the weekend, Musk said the platform will rebrand as X, part of the app's move in a new direction. All of the Musk changes have, on the one hand, been welcomed by some, but creating an opportunity for social media players to jump in, given the disruption. For instance, we saw Threads unveiled by rival Meta recently. That is the parent company of Facebook, which also has earnings out this week. For a preview, let's bring in Deborah Williamson. She's a principal analyst at Insider Intelligence and a longtime social media tracker. Deborah, nice to have you back with us. I guess let's start with this unveiling of this new X logo and X rebranding. What was your reaction to that?
Yeah, it's wow. It is a huge moment in social media. Many of us, myself included, we grew up in the social media space looking at Twitter, following Twitter. Twitter has enormous brand recognition, even though its user base has never really kept up with some of the larger platforms. Everybody knows Twitter. Everybody knows that Blue Bird logo. And so this rebrand is really huge news. And it's been called, I think, something of a Hail Mary for Elon Musk because of all of the challenges that Twitter has experienced over the past year or so when Elon Musk has been associated with the company. It's also been said that, is Elon Musk, is he helping the Twitter brand or is he hurting the Twitter brand? And at this point now, by changing the name to X, he does have sort of somewhat of a blank slate to try to build a new service that maybe has new features, new things, and maybe leave some of that turmoil that's been going on for Twitter for months and months in the dust. It's going to be a very interesting one to watch, and it definitely tells me that, as is the usual for social media, there's never a dull moment. There's always something going on in these companies, and they make news and they move markets.
There have also been frequent references to how social media platforms can evolve to have more elements. There's a frequent reference to WeChat in China as an everything app, and Musk is in many ways positioning X as an everything app. For those who aren't familiar, what exactly does WeChat look and feel like? How might that inform us on what X/Twitter looks like going forward?
Yeah, it's an interesting one and definitely been talked about for several years, like you mentioned, not only with Twitter and X, but also with Meta and what Mark Zuckerberg might want to do with, say, WhatsApp or Facebook. So WeChat is what you would call a super app. It's multiple things all rolled into one app. So imagine being able to not only social network and communicate, but pay bills, hail a taxi, find a ride share, order food, bank, all sorts of things rolled into one app. And so it's been hugely successful in China. China's payments infrastructure has really built up around this idea of super apps. What's interesting to me about what's going on with X, and perhaps also tying this into Meta and what Mark Zuckerberg might want to do with some of his apps, is that in the Western world, and particularly in countries like Canada or the United States, the payments infrastructure is very different. People are used to using credit cards. They don't necessarily trust their social media apps to make payments and to interact with their banks. And so that, I think, has always created a bit of a tension and a bit of dysfunction in the idea of creating a super app in North America. And so it's going to be a big challenge, I think, for Musk. I mean, he does have background in payments with his association with PayPal, so he definitely knows how to do it. It's just really, to me, going to be a question of, do people want this from X? And can he create something new? I mean, again, X is this sort of unformed brand right now. Can he make a brand that people want to interact and engage with in all these different ways that I discussed, like they might do in China with WeChat?
Interestingly enough, while we're going to be focusing on Facebook's parent Meta this week with their earnings, While the apps themselves, Facebook, Instagram, they're still Facebook and Instagram. The company quite literally changed its name, as is the case in, Twitter becoming X Corporation and Facebook becoming Meta Platforms to leverage Mark Zuckerberg's dreams for the metaverse. Now, a lot has changed since those initial plans were unveiled, including a real sell-off in the stock. But this year, investors have fallen in love with big tech again. They've fallen in love with AI themes, and presumably they think Meta's well-positioned to cash in on that. What would you say about the business? What are you seeing right now?
Yeah, I mean, I think we saw better than expected results in Q1 for Meta, and we're expecting Q2 to look similar or perhaps even better. We think that there were a couple of factors that might have helped Meta in Q2. One of those is the strong performance of an advertising automation tool that Meta has been rolling out. It's called Advantage. We're seeing stronger momentum for advertisers gravitating towards Reels, which is Instagram and Facebook's counterpart to TikTok. And of course, the slightly more optimistic economic outlook going into the second half of the year, I think also has benefited Meta. So overall, while we don't at our company publish quarterly estimates for how much we expect the revenue to grow, we think that if Meta can reach the upper end of its guidance that it published last quarter, that it might show even as much as double-digit year-over-year revenue growth, which would be the first time since Q4 of 2021 that it would achieve that.
Well, that'd be interesting to see. And obviously, after the big run-up in stocks like Meta this year, investors are curious as well. Hey, Deborah, thanks very much. Great to have you back with us.
Thank you.
Deborah Williamson of Insider Intelligence.
Well, we've been watching shares of PacWest this afternoon tumble down nearly 27% to end the trading day. And that was followed up by news that Bank of California will be buying PacWest in an all-stock deal. They're calling this a transformational merger between these two companies. PacWest stockholders are going to receive 0.6569 of a share of Bank of California's common stock for each share of PacWest, a stock that they own. In the press release here, we're seeing the two banks calling this or describing this as a merger that will create the premier California business banking franchise, which will be well positioned, they say, to capitalize on market opportunities. But yeah, quite the reaction we saw in PacWest shares this afternoon, plunging. While we watched Bank of California shares jump about 10% to end the trading day on this report that the Wall Street Journal was saying that this was going to happen, that Bank of California and PacWest were in talks to come together, and then confirmed after markets closed here that this will indeed be the case. Well, tech giants Microsoft and Alphabet have both reported quarterly results. Both companies beat street expectations on sales and profit, but we are seeing a bit of a mixed reaction in after-hours trading. So let's bring in Scott Kessler, Global Sector Lead for Technology, Media, and Communications with Third Bridge, for some help digesting it all. Scott, so maybe we could start with Microsoft, because it did look like a beat for Microsoft. However, the reaction in after-hours, at least initially, did look negative. Yep, we're seeing it down 2.5%. What do you make of the results? Was it just expectations were particularly high going into this?
Yeah, I think going into these results, the way that we were thinking about it is expectations were elevated, right? And so what that means, of course, is that the company is going to need to do more than just meet or slightly beat expectations to get people excited. And so we'll see what the company says in the context of the conference call. That being said, this is a stock that I think was up about a third, 34% year to date through yesterday. So it seems like a lot of investors were anticipating very good things from the company, and maybe more will come out in the context of what the executives disclose a little later.
Yeah, in terms of that earnings call, what would you be listening out for when it comes to, the AI component here? Or is there anything from what we've seen in the headlines that, gives us a sense of, the artificial intelligence and the investment that Microsoft has been doing into AI and how that's driving things?
Well, so I think everyone is going to be focused on, the kind of twin mega trends of the moment in technology, those being cloud and AI. In terms of cloud, everyone's going to focus on Azure. I think they indicated kind of 27% growth, which I think was, probably roughly in line with expectations. But importantly, people want a sense of where that business is going to grow over the next quarter, the balance of the calendar year going forward, et cetera. And typically, at least over the last couple of quarters, Microsoft has given those types of indications. So I think that's number one. And then I think number two is Microsoft has done a lot and got a lot of attention for investments in and efforts around AI. But now I think people are going to want to start getting a sense of how that's going to start impacting the top line. Have we seen traction? Is there going to be more? Are we going to see more product introductions? So I think there should be not just more discussion around that, but some pretty specific questioning about what people should be able to anticipate for the next quarter or two.
And what about Alphabet? Because when we're taking a look at those results, it looks like a strong ad spending, both on Google and on YouTube, beating expectations. And yeah, we're seeing the stock in after hours jump 7% at this point. What really jumped out to you about Alphabet's results?
Well, what's interesting, right, is that I think if people just kind of looked at the results on an absolute basis, they would say that maybe both companies did pretty well. The difference is that the kind of anticipation from Microsoft was, I think, so much more kind of significant and positive. Whereas I think Alphabet, this is a company that I think has been perceived for the last number of months as kind of behind the curve a little bit, right? It seemed like they had to rush out Bard because Microsoft had really taken a lot of the mojo, if you will, when it came to AI, whether it's the launch of OpenAI's ChatGPT, or the increased investment, or the alliances between the companies broadening, or product introductions. It seems like Microsoft has had a lot of the AI-driven momentum, whereas I think Alphabet/Google has been thought of as kind of, scrambling and playing catch up. And so the expectations, I think, were more muted. And so when you go ahead, I'm sorry.
Oh, no, that's really interesting stuff, Scott. I think we have to leave it there, but really interesting to take a look at, the two. Microsoft, it's out ahead, and maybe that's why the reaction today. And then Google, maybe it's making, some attempts at catching up there and making some progress. Really appreciate your thoughts, Scott. That was Scott Kessler, Global Sector Lead for Third Bridge.
Rogers Communications is also a PowerPoint on the TSX after the company reported quarterly results. It has struggled so far this year, and the quarter was a little messy due to their gobbling up of Shaw Communications. To unpack all of it is Paul Bagnall.
Yeah, huge increases, as we will see in a moment, in almost all of the key financials, as you would expect when one big company buys another big company. And that's what happened finally in April when the acquisition of Shaw Communications by Rogers went ahead. Here, first of all, is a look at the company's updated financial guidance. It sees a much stronger 2023 than it did earlier. Adjusted EBITDA, which is the key profit line for a telco, now seen as being up between 33% and 36%. And there, of course, you see the effect of the Shaw acquisition. Now, the earlier guidance also assumed that Shaw acquisition. The earlier guidance was for adjusted EBITDA to rise between 31 and 35%. Free cash flow is important because the debt metrics at Rogers have increased. The debt to EBITDA ratio is now about 5 times. Free cash flow expected to come in this year at between $2.2 and $2.5 billion. That is more than the $2.0 to $2.2 billion foreseen. The company's also bumped up its guidance on things like service revenue, which is the revenue it gets from all those people who subscribe to its services. Here are some of the increases that we see in the numbers from Shaw. They're very large. Revenue up 30% from a year ago to over $5 billion. Service revenue up 32% from a year ago. Adjusted EBITDA up 38%, and free cash flow, again important with the debt task that the company now has in front of it, up 38% to $476 million.
So on Shaw, because of that integration, it's still early innings. Those so-called magical synergies still need to play out. What are they saying about that?
The company says the integration is ahead of plan. It says it's integrating the Rogers and Shaw branding in Western Canada and are getting set to go to market with that renewed branding. Rogers bundles are being offered to Shaw mobile customers. Rogers wireless plans, I should say, being offered to Shaw mobile customers, and Rogers internet and TV services are now available in the Shaw territory as well. And the cost savings, the all-important cost savings, that work is on schedule, according to the company's executives today.
All right, thank you very much.
Thanks.
That's Paul Bagnall reporting on the strength that we're seeing in Rogers.
Okay, Baytex Energy is out with its earnings now. The company is including in this latest quarter just 11 days of operations of Ranger Oil, which is the U.S. company that it bought for more than $2 billion. We're joined by Eric Grieger, CEO of Baytex Energy. Eric, give us the quick and dirty on the quarter, and thanks for joining us. What were the main points of this quarter, please?
Well, good afternoon, Andy. Thank you. Lots to discuss. As you know, we pre-released on June 20th, but today we've released our Q2 results in full. Production above the high end of the pre-released range, capital near the bottom of the range. Solid quarter, strong company, sitting on significant base of quality assets, lots of opportunity. As I said before, we're a better company combined than either company could have been standalone. In 2023, we'll generate $500 million of free cash flow. Half of that will be allocated to debt reduction, and half of that will be allocated to shareholder returns. As you'll see in our press release that's hot off the press, the NCIB is underway, so we've been repurchasing shares through July.
Just let me get this straight. This deal essentially doubled your production. You're looking for production in the second half of up to the equivalent of 157,000 barrels of oil a day, whereas you were about 88,000 in the first half of this year.
That's right, Andy.
Tell us, were there any surprises with the Ranger assets in this quarter? Now, you don't actually operate the Ranger assets, I don't think. Correct me if I'm wrong.
No, we do.
I'm sorry.
They're operated assets, and that was part of the rationale was to really build an operating capability that is, very, very well respected in the area with deep experience. And so that's almost entirely operated working interest in the Eagle Ford Ranger lands.
I see. And what is the Eagle Ford rate? It's light oil, essentially. That's what you're tied to there?
Yeah, light oil, obviously lots of NGL production out of the natural gas stream, and then obviously residue gas as well that sells into the Gulf Coast market.
Now, last month, RBC put your debt at about $2.5 billion as of June 30th. I haven't had time to look at your latest balance sheet. Is that about right, though, $2.5 billion?
Yeah, it's actually a little up from there. A combination of working capital adjustments and slightly lower than forecast operating income from the first half on the Ranger side, mostly due to commodities. Yeah, that's about right. And you'll see in the press release that it's just a hair higher than that.
What do you want to get it down to? What's your target?
Well, our next milestone is $1.5 billion. And we think that is significant, one, because it really is tagged to about one turn at $50 WTI. We think that's a very conservative anchor point, at which point we'll then reallocate up to 75% of our free cash flow, return to capital as shareholders. We'll continue paying down our debt even below that $1.5 billion, but it'll be at a slower pace where we'll be allocating just 25% to debt reduction.
Right. Now, what are you doing about the dividend? What will your annual dividend rate be in the future?
Yeah, so we're pretty excited about this. We've now formally declared the dividend. It's 9 cents per share per year, paid quarterly. And that will be for shareholders of record on September 15th for Q3.
Right. So, sorry, 9 cents annually for paid quarterly.
Yeah, it's paid quarterly, but it's 9 cents per share per year. So
yes,
another way of saying that, just to be clear, is it's like 2.25 cents per share per quarter.
No problem. So your stock today traded at around $4.87. So not a big yield from the basic dividend, it looks like.
That's right, Andy. It's a little under 2% base dividend yield today. And modest, and we'll admit that, but it's a good place to start, because as we allocate shares to the NCIB and we take those shares out and cancel them, there'll be fewer and fewer shares, and we can use that additional, free cash flow to either raise the fixed base dividend, because there'll be fewer shares against which to pay the dividend, or continue with the same fixed base dividend and keep paying out on the NCIB. So we'll have options. We start at the I'd say probably in the bottom third of our peer group in terms of base dividend yields, with some room to move up, and that's a nice place to start.
I just want to very, very quickly check here. So your general and administrative guidance for 2023 has been revised up to $1.80 per barrel of oil equivalent from $1.63. Why is that?
Yeah, so all included in our our total cash cost structure, our operating expenses came down substantially, about 13%. But there were some other items, including G&A, that moved up. All in, the cash cost structure actually moved down just a little bit on a pro forma basis. But on the G&A, because we brought the entire operating team over, this is essentially a bolt-on business unit. Because again, we were standing up not only the Ranger assets, but also an operating team to help us have the capability to swap and trade and create increased operated working interest using this operated team. And because they're paid in U.S. dollars, when you bring in an entire operating team from the U.S., it puts a little bit of upward pressure on the G&A when it's expressed in Canadian dollars on a unit basis.
Eric, thank you very much indeed for joining us.
Market reaction has been mixed so far to the plan by TC Energy, one of Canada's premier pipeline operators, of course, to split itself into two. TC plans to spin off its liquid pipelines business into a separate publicly traded company. That would make TC itself a pure play in the natural gas infrastructure sector. Our next guest likes the plan. He's Stephen Ellis, equity analyst at Morningstar Research Services, and he joins us now. Stephen, thank you for joining us. Why do you like this plan by TC Energy?
Yeah, so I think it's a pretty interesting deal. I think there's a couple benefits. First, it really highlights the value of the gas and the power assets that have an expected 7% CAGR growth prospects through 2026, compared to the oil assets, which are 2 to 3% over the same time frame. And second, I think it helps TC Energy achieve its debt-related goals. The oil spin-off is supposed to be capitalized at 5 times debt to EBITDA, and TC Energy has a goal of reaching about 4.7 times by 2024. So there's potential for this to help, lower the leverage at TC Energy and help it achieve its goal there. And third, this also cleanly separates, from an ESG perspective, the oil assets, which have more challenges from an ESG perspective, for the more attractive gas and power assets, which have opportunities with carbon capture and hydrogen.
Often when companies split themselves into two, they do so in a way that separates growth assets from more stable performance assets. And I think I hear you saying here that TC with the natural gas infrastructure focus would be more growth-oriented than the liquids pipeline business, which would be spun off into a separately traded public company. Is that correct?
Yep, I would definitely agree with that. And, I think, for example, the Keystone XL cancellation from several years ago certainly played a part in that, sharply reduced the growth prospects in the near to medium term for that crude oil portfolio.
And why is natural gas growthier? The price tends to be much more volatile, but these are, of course, TC is not a producer of the product. It's a carrier and a storer of the product. Why is the natural gas segment growthier, to use the language of some analysts, than the oil liquid side?
The big growth driver is really LNG. And, Canada, I think, after many, many years and many struggles, actually has some very viable growth LNG projects coming online. We have LNG Canada coming online in a couple of years, and then we have another prospect coming online, potentially from Pembina. So, and that is a really big driver for gas demand, and because be able to export that LNG to Asia, and particularly China. The alternative, of course, is we can move it down to the Gulf Coast for export to Europe as well. So there's, that's really the big growth driver for the gas side of the business. And, TC Energy, I think, is very well positioned on that side with about 30% share on LNG.
A short time ago, we took a look at the one-year history of the TC Energy share price. Perhaps we can bring that up again. It has been dismal. The shares are trading at a clear 52-week low. It's likely a multi-year low. What has been the issue with the share price performance of TC Energy? I know, and I think most viewers know, that rising interest rates are a headwind because they make the dividend less appealing versus other options in the fixed income market.
Yeah, the dividend is and interest rates are certainly a headwind for sure. There is definitely a bit of investor preference that can take place there. I would highlight the other major thing, I think, being the Coastal GasLink pipeline overruns. That's been pretty substantial, and it is not yet complete. So while it's very close, we are still wary of the fact that there still could be potential overruns. However, I do think that once the Coastal GasLink pipeline is in service, that will help shift the investors' focus to more on the highly attractive assets that TC Energy has. For example, in Mexico, they're talking about doubling earnings over the next few years. So Mexico is a pretty attractive growth story for them. And with the power business as well, they are looking at hydrogen. And, I think the spin-off will help highlight, those sort of growth opportunities they have as well. So net, it does seem like the story is turning certainly a little more positive than it has been from somewhat negative story before.
What would be your view of the separately traded oil pipeline company? No name yet given to that company, but what type of performance would you expect there? What type of investor would be suited to that stock?
So for that stock, because it is, heavily linked, I think, to refinery demand, and it also is relatively slow growth. I mean, the closest peer would be, in my view, would be something like MPLX, where you would have, very, very steady but highly durable demand from those refineries over time. So, and that would also, I think, lead to, very healthy dividend stability. So, there is potential for this to be sort of a high yield, sort of steady growth type play, which could be an attractive way for investors to look at it and potentially own it.
How would the new TC Energy compare to its peers in Canada, Enbridge, Keyera, and so on, the other big pipeline operators here?
So the new TC Energy would be essentially much more heavily weighted toward gas. It would certainly be, the giant in the space within Canada. And the closest peers would probably be, something like, Kinder Morgan and Williams in the U.S., which, where their stock prices, I think, have been doing quite a bit better recently than TC Energy. So that could be certainly supportive of the fact that TC Energy is looking for the split when they were looking at those better performing U.S. peers.
Stephen, thank you very much for this. That's Stephen Ellis. He's an equity analyst at Morningstar Research Services, helping us understand a big story in the Canadian market today, the plan by TC Energy to split itself in two.